Hello and good afternoon. Welcome to this week's webinar from Thomas Westcott on exit strategies for business owners. My name is Patrick Tigwell. I'm a general practice partner with the firm at their Exeter and Tiverton offices. And again, it's my pleasure to be your host for this afternoon. It's also great that we had so many people book up to watch participate in the webinar. The last count was 150, so that's really good. So thank you very much. And I'm delighted that we're putting on this webinar because, in my experience as a general practice partner, too often I think business owners don't consider the exit strategy and what their exit plan is, despite maybe most of them saying, well, the business is their pension. So really looking forward to this afternoon's webinar. To guide you through the many issues, we have a great batting lineup for you today. First up, opening the batting, as it were, will be my Exeter colleague, Alison, who heads up our corporate finance department service line at Thomas Westcott. I would point out that on the original flyer that you may have seen, she was badged as a corporate finance director. Well, nothing could be further from the truth, because now she's been promoted to partner, the giddy heights of partner. So it really very well done to her, and to sort of channel a sort of Wayne's World reference, we're not worthy, we're not. Alison will be explaining the different routes available for business owners to consider, but as you may have guessed, each of those routes will come with its own little package of tax consequences. So to further explain those, we have my esteemed Plymouth tax colleague, partner colleague, so continuing the theme, Ian Pring, and he'll be sort of explaining, all the tax ramifications of whatever strategy is being chosen. One of the particular characteristics I do like about our webinars at Thomas Westcott is that we generally have an outside speaker to give a different perspective on the topic in hand. So I'm therefore delighted to welcome Giles Dunning to the call today. Giles is with Scown solicitors and heads up their corporate department at Exeter. He's also a partner, so there's a consistency of theme here, and he'll be presenting, obviously, as you might expect, on the legal issues, including due diligence, the transaction process, heads of terms, sale and purchase agreements, and warranties, and to name but a few. I'd also like to thank Alex Eastland, not Elisa. She's on Elisa's sort of login there. Alex is in our marketing team, and she's sort of produced the webinar today. She's also recording it, and we'll send out a recording of that to all of you, our lovely attendees, afterwards. We've planned for an hour today, so we'll hear from the three speakers in turn. There'll be some questions along the way, I'm sure, and then time for questions at the end. We have had some questions already submitted during the registration process, but if you haven't, you still can using the Q&A button down there. Please post anon if you don't want your name read out, but I don't generally do that anyway. And for practical purposes, don't forget that we can't really answer very specific questions. If you do ask a question like that, we'll try and answer it in more general form, but it could be that we'll answer it after the webinar's finished. On that note, if you do have a question when the webinar has finished, you still can ask a question at events@thomaswestcott.co.uk. So that's all the kind of housekeeping and intros done. So without further ado, I'll hand over to Alison for her slot. So Alison, over to you.
Thanks, Patrick.
Slight hiatus while you're sharing your screen. That's it.
Yeah, can everybody see that?
Perfect. Yeah.
Okay. So yeah, good afternoon, everybody, and thank you very much for joining us. And thank you, Patrick, for that introduction. I'll be covering in the next sort of 10 to 15 minutes a sort of outline introduction to exit planning for owner-managed businesses. It will cover things like, why have an exit plan, the key drivers and considerations you should think about whilst you're putting your plan together. I'll briefly touch on valuations, as obviously the value of your business, as Patrick said, is key, and quite often is the pension pot for business owners. And obviously alongside that is actually how you maximise your value in your business when you do come to exit. So we'll touch on a few things on that as well. Then I'll look at the exit options that are available and the ones that we commonly advise on for business owners. And then after that, I've got a few closing thoughts to leave with you before passing on to Ian. So looking at exiting your business, this is often one of the biggest challenges for business owners. And it's very important to get it right because it obviously will then provide the income for your retirement or when you go on to do other things. So it's very important to take the time to get it right and actually to start planning early. It's never too early to start planning for your exit. And this ensures you get a much smoother process and obviously a better outcome at the end of it. It's interesting that most businesses that we work with would always plan to start a business and have a business plan, but very few of them actually plan for their exit. And I think a statistic I saw recently said probably less than 10% owner-managed businesses actually plan for their exit. So our advice is normally to start 3 to 5 years before you actually want to achieve an exit. So thinking about now why do people exit? Why do owner-managed businesses decide to exit their businesses? There's obviously a number of reasons, and the reasons why can also drive how you want to do it, and as one of the major considerations. I mean, in terms of exiting your business, obviously everybody at some stage will transition out of the business that they own and manage. But it could be that you're looking to retire, you've come to that stage in your life where you've got different priorities, and you want to go and spend the rest of it on the beach. I'm just looking at my beach photo. I can't think that that's Devon at the moment, given the rain, but it might be later on in the summer. One of the other major areas as well is there's no natural succession for the business. Whereas in the past, a lot of businesses have passed on to family. Things have changed now, and often there isn't some natural family succession in place. And youngsters go off and do other things, and the world's a much bigger oyster now, isn't it, for them? So I think the lack of succession is one of the key drivers for exiting the business. Objectives can change. You can have built up the business and actually now maybe feeling that you've had enough and don't want to take it any further. And actually, you've got to change in your objectives personally and also business-wise. A step change, there could be a step change in your business that it's got to a point where it actually needs investment, it needs some growth, and actually you don't want yourself to take that risk and do that step change. So that can be a driver for an exit. And also a new challenge. A lot of business owners, especially those who have a real entrepreneurial spirit, can get bored once they built the business up and actually want to go and look for a new challenge. But as I said before, all business owners at some stage will need to transition out of their business. So starting to look at the sort of exit planning process and preparation, I thought it would be useful to just talk about some of the key drivers and what's going to drive how your plan is formulated and what your end option is. Your personal circumstances are obviously key to this. Your age, your health often comes into it, your family situation, and other personal circumstances that can drive your decision to want to leave your business or exit your business. Your own personal objectives in exiting, in terms of when do you want to do it, what value do you want to get out of your business, and who would you want to sell it onto or pass it on to, are obviously key drivers in the plan. The business life cycle stage, so where your business is in its life cycle, will be a key driver. Are you in a growth stage? Are you is it a steady stage of your business life cycle, or is the business actually in decline? So again, that's a key driver for the planning. And then coming on to value, maximising your value, that's the key driver for most business owners, because that then leads into providing the income needs in your retirement. So it's important to look at those income needs post exiting the business, whether it's retirement or moving on to other things, and actually seeing how that equates back to what your business might be valued at. There are other considerations which shape the plan, things to think about. One of the things is your active role. Do you want to have an active role in the business? Most business owners will have some sort of handover when they leave the business, How long do you want that to be, and how much involvement do you want to have? Think about who can take over from you. You know, what are the management skills of the people left behind? Are there the management skills there to run the business once you've left it? If it is a family business or with other shareholders other than perhaps sort of man and wife shareholders, you need to think about their needs and what their involvement wants to be, and also if, you know, they have income that they need to get out of the business going forward. And a very important point as well is the impact of your departure. If you leave the business, you know, what's going to happen? Is it going to decrease in value? Is it going to suffer? I mean, one advice is try and make yourself redundant in your own business, which means they're not reliant on you in the future. And then one of the other key areas is the sustainability of a business. How sustainable is your business in the future? And how sustainable are those earnings? Because that's what's going to drive the value and what someone's prepared to pay for it. So it's very important to look at those issues around the sustainability of your business if you want to try and maximise the value. So looking at that, I'm going to perhaps touch now on valuations. I'm not going to go into a full valuation workshop, but I thought it'd be useful to just talk around the key aspects of valuations in businesses. We get asked the question all the time, how much is my business worth? That's a very difficult question to answer. So I normally answer initially with saying it's what someone's prepared to pay for it. And that is very true. You only know the true worth of your business when you put it on the market and get some offers forward for it. It's not a scientific process, valuing businesses, and it's very subjective. But obviously, as part of your plan, business owners want to understand what their business might be worth. So we undertake quite a lot of desktop valuations for clients, and there are set processes and procedures and principles to take into account when valuing a business. So I thought it'd be useful to just touch on those so you can get an understanding of what other things you need to think about as you're pulling your plan together. We're really looking here at trading businesses. I'm not talking about investment companies or ones with huge assets. It's about a trading business. And the key principle of the evaluation for a profitable trading business is what is its level of maintainable earnings? And that's the key, it's the maintainable earnings. And what are the risks around those earnings in the future? And that's what drives the multiple. How many times those earnings is somebody willing to pay for that business? So the risk of those earnings being there in the future is a key factor. And the lower the risk of those earnings being there, the higher the multiple, so the higher the value. There are other elements that come into the valuation. So you could work out what your maintainable earnings are, and this is what we do in a desktop valuation. We explore what the multiple might be, which includes quite a lot of background information about the business, its markets, etc. So there's quite a lot involved in that. And then you have to look at what debt the business is carrying, and also if there's surplus cash and other assets. But the key is about having a level of maintainable earnings that you can prove to a buyer that those are going to be there in the future. So it's a good exercise in terms of, in relation to trying to maximize the value, is to take a critical view of your business before you start to put it on, plan for your exit. So where is the business now? Have a look at what the business is doing now. What does it look like to a potential buyer? What are they going to see when they look at your business? And obviously you're trying to look at what the issues may be for them and the things that are going to devalue it. And one of the starting points that we use, because we do quite a lot of pre-sale reviews for clients on their businesses, is to do the good old SWOT analysis. I know that's been around, probably longer than most people on this call, but it is a very, very good tool looking at the strengths, weaknesses, opportunities and threats surrounding your business, and gets you to focus on those areas. Other areas to look at is the management team. Are they good enough? A buyer into your business is unlikely, unless it's the management buyout, is unlikely to have its own management team that they can parachute in. So actually, how good is that management team? Does it need strengthening? What are the opportunities for growth? Can we show growth opportunities in the business? What's the potential? How can that be made the most of? Dependence, we talked about making yourself redundant. the dependence on you, how dependent is the business on you? Where do the relationships sit with the customers, suppliers, etc.? The reliance on one or two specific customers or suppliers can also cause a concern to a potential buyer. So look at the reliance on those key relationships. Financial information, the quality and timeliness of this is important for the buyer to actually understand, what the value is in the business going forward. And then the actual infrastructure of the business, in terms of, has it got a robust infrastructure in terms of systems, procedures, some of the, Giles might touch on this, some of the legal stuff in terms of contracts for employment, contracts with customers. So there's a lot to think about when you're looking and doing a critical review of your business. And as I say, that's something we do in a pre-sale review. The other thing that's important, I think, is to link your exit plan when you pull it together with your strategic plan, because obviously, as you can see, they will run side by side as the strategic plan will start to drive those maintainable earnings. So once you've done that review, it's looking at what the issues are and actually trying to address those before you start to actually implement your exit plan. And if it's a sale, go to the market. Okay, having considered, what we've just discussed above in terms of, planning, it's also obviously now considering what are the routes to exit. What are the options you have to actually implement an exit from your business? The main routes I will just run through now that we see and we advise on. Family succession, as I said before, where there is a succession, is often a route for an exit. And this could be gifting or selling shares to the family, and also using what's called a CPOS, which is a company purchase of own shares, where the company can buy back its shares, leaving a remaining shareholder with 100% if that's what's required. MBO, MBI, those are management buyouts and a management buy-in. Management buyouts is where your management team purchase the business from you, and that can be quite a good route to go down because they obviously know the business well, there's good relationships, and it can be a smoother and quicker process. Management buy-ins is where an individual comes in and buys your business, and that can sometimes be a bit more difficult as they have to embed themselves with the existing team. Employee buyouts, that's seeing a lot more employee buyouts and the use of employee share ownership trusts to actually affect an employee buyout. That's where a much bigger group, obviously, of your employees are buying the business from you, not just 3 or 4 of the management team. One of the main routes for business owners is a sale to a third party. So this could be a sale to a corporate buyer or to a private equity or family equity type house. So in a sale to a third party, what you're doing there is creating a market for your business, and the business is put on the market in a confidential basis, and people are asked to put forward offers and make a bid for your business. This obviously, by creating the market, you're creating the competition, and this can drive up the terms and the prices for you. An IPO is another exit, which is an initial public offering where you go onto the public markets. This is something that we don't tend to get involved in because a lot of our clients and business owners are not of a size or a stage where they can actually go for a flotation. And the final option would be to close and then liquidate the business. I would say this would be a last resort for a trading or profitable business, but sometimes it's a route that people want to choose. So as you can see, there's quite a few options to consider. So just to leave you with some closing thoughts, I think the key things that I would say are take time out of your business to actually think about your exit and plan for your exit. Start planning as soon as you can, and obviously take advice. I mean, obviously we'll say that, won't we? But I mean, that is, I cannot express how strong it is to have the right advice. You only get one chance to exit your business normally. And if it's your big pension pot, then it's really important to get all the advice you need. Explore all the options. There are a number of options around, and find the right one that suits you and meets your objectives. And then the other side is obviously there are a lot of tax consequences to all those routes I've just mentioned. So actually know what those tax consequences are and make sure, again, you take the advice and build that into your plan. So with that, I think I'm going to pass back to Patrick, and I think we're going to be talking about some of the tax consequences of exit.
Thanks, Alison.
Thanks very much.
Just before we sort of move on, we have had a question about whether we provide e-certificates, obviously for the CPD. We don't, unfortunately, so apologies for that. That's not something we can do. But getting back to the matter in hand, a couple of questions then, Alison. On one of your first slides, you said about thinking about an exit 3 to 5 years, before you do exit, obviously to prepare the business. But how do you know, when is the right time? How do you set the end date, if you like, to then work backwards from that?
Yeah, I suppose the right time is I say that's why we talked about thinking about your personal objectives and all those sort of issues. It's important to think about that. I mean, when is the right time to exit your business? I would say it's when you don't need to exit is a better time to exit your business. So you don't want to be pushed into a position where, because of health or age or other issues, you actually need to exit. So, which is why we say start to plan now and think about, 3 to 5 years ahead. I suppose the key thing as well is going back to one of the points I made about maximising your value. Sometimes you need to build your business up to a certain value for you to be able to then have the income that you need in retirement. So again, looking at your income needs and maybe getting a desktop valuation done of your company now to see if that will give you the value that you need to support you in your retirement can also drive when is a good time to exit your business.
Yeah, thanks. And I think also that I know many deals, the outgoing proprietor has to kind of stay in there, doesn't he or she, to help the sort of the handover and the changeover, and to help sort of embed the value that they've sold their business for. So
yeah, absolutely, yeah.
Don't want to be completely leave it to the last minute and you're too sort of decrepit to move.
Well, no, that's right, because it's very difficult, I think, for owner-managed businesses to completely make themselves redundant. So, as you say, in most deals, the buyer, whether it's a management team or whether it's a corporate buyer or private equity, will want the owner to stay on to help with that transition. And sometimes that can be up to 3 years. This was last year, and one of the owners is staying on for 3 years, just to ensure that value for the buyer comes through.
All right, thank you, Alison.
Okay, thanks.
We'll move on now to Ian for your presentation on the tax consequences. And Ian, so
okay, thanks, Patrick. I'll try and share a screen. Hopefully, is that visible?
Yep, perfect.
Good, thank you. Technology's working. Alison mentioned, I'll go through some of the sort of tax considerations to think about prior to sale and just comment on some of the routes that were suggested to exit. So first thing, I think, Patrick, you said, a lot of business owners view their business as their pension. They've grown that pot. They haven't necessarily taken out all the value out every year because income tax rates are quite high, or have been historically, and capital gains tax rates have traditionally been quite low. And in terms of what are the current capital gains tax rates, I've just simply listed those on the screen. If you're selling anything other than residential property, you'd expect to be paying 20% capital gains tax of a gain of any size. Some of it can be at 10%, but you'd be expecting a 20% rate on disposal, subject to what used to be entrepreneurs relief, and I'll come on to that. But of course, the Office of Tax Simplification did last November come out with a suggestion to the government about increasing capital gains tax rates to more closely align with income tax rates. So, as a driver to potentially why there might be more sales going through, or whether not that tax should necessarily be a driver, bear in mind capital gains tax rates might be going up over the next few years. Annual allowance has been frozen. We don't quite know where capital gains tax rates will go, but potentially only upwards. One of the first routes was just simply pass the business on to your family. But be aware that passing an asset to by gift to family or others it's a disposal for capital gains tax. It's a disposal at market value. So if you're passing on the family a buy-to-let property or family shares, you're making a disposal for capital gains tax. If it's a business asset, if it's a shares in your trading company, you can get gift relief. So I've just simply given the example here of if you've got shares in a company worth 500,000 and you give it to your son, well, you're deemed to have made pretty much a £500,000 capital gain. If you've got a negligible base cost, you could find yourself paying nearly £50,000 if you've got business asset disposal relief, or up to 100,000 if you haven't, if you don't make an election. If you're eligible for the election, if the shares are in an unquoted trading company, then you'll be able to give a holdover election, a gift election, and avoid the capital gains tax. But there are tax implications of simply gifting, but it is possible when you're dealing with trading assets to pass it over to next generation and avoid the tax and just pass your base cost on, really. So if they ever sell, they're selling at your base cost. Historically, we've always had a favourable relief for sale of businesses. It used to be retirement relief, then it became business asset disposal relief, then it became business asset taper relief, then it became entrepreneurs relief. Since April, it's been renamed as business asset disposal relief. And it gives you a 10% tax rate on sale. Now, over the years, since 2010, it's worked its way up to 10 million. But from last April, it's come down to 1 million. So you'll only on sale as a shareholder get the first £1 million of gain. And they look back from 2008 when it talks about a lifetime limit. So if you haven't made any disposals since 2008 on which you've claimed entrepreneurs relief, you've got £1 million worth of gain that can achieve a 10% tax rate. They've similarly, last year, 2019, I think it was, they extended the qualifying period from a 1 year to a 2 year period. So in order to make sure you meet the conditions, we now have to meet it over a 2 year period rather than a 1 year. So when I come on to it on the next slide, you've got more time to get, or less time to get it right, if you like, before sale, whereas previously it was just a year. And again, the final comment there, the Office of Tax Simplification did also talk about replacing business asset disposal relief. They were looking at abolishing some relief. So whether this stays with us, we will see. So if you're a shareholder in a trading company and you're expecting to get your 10% tax rate, well, like Alison's saying, you can do a pre-sale review. You as a shareholder, if you're expecting 10% tax rate, should be doing a similar tax review to say, do I meet the conditions to achieve a 10% rate on sale? So do I hold at least 5% shareholding in the company? And that's 5% of votes, 5% of shares, 5% of proceeds on a winding up or on sale. So it's quite a complicated test. Is it a trading company? Well, we'll come on to that. And am I an officer or an employee? Well, officer or employee, that should be easy. You're either a director, a company secretary, or you're on the payroll. It doesn't have to be a paid role, but you need to be evidenced at Companies House as a director to HMRC. And you need to satisfy those conditions for 2 years up to the point of sale. Or if actually you're not selling necessarily, you're just closing the doors of business and liquidating, then you have to meet those conditions up to the 2 years for the 2 years where you cease trading, and then you have to wind up, liquidate within 3 years and get the money out to still get the 10% tax rate. Now, what's a trading company? The revenue use a 20% test. They say that the company can't carry on to any substantial extent a non-trading activity. So if you've got buy-to-let investments in there or investment activity, stocks and shares portfolio, cash, you have to be careful that it doesn't take over time and move from a trading company, or substantially a trading company, to one that has a large investment activity. And again, part of a review would be, have we got a lot of surplus cash built up on the balance sheet? Is that a problem to business asset disposal relief, and possibly also for inheritance tax business property relief? Actually, HMRC are fairly pragmatic about cash. If the cash has accumulated from trading profits over the years and it's not actively managed, they don't necessarily look at it as a problem. But if you are actively managing the cash as an investment activity, it will count against you when looking at, is the company a trading company for the purposes of the substantial test? Have you used cash buying investment properties, commercial property, buy-to-let, residential property? A lot of our client companies have been going into property. Well, the buyer won't necessarily want to take that with the company, and it might also be a problem to your 10% CGT rate. So that's when we have to talk about a demerger or extracting the investment assets that the buyer won't necessarily want in good time prior to sale. And also, if there is uncertainty, it is possible to get a non-statutory clearance in terms of, is this a trading company or not? I, as a shareholder, need to know, if I sell, can I self-assess and claim business asset disposal relief? Is it a trading company? You can seek those clearance. So company purchase of own shares, as mentioned, and that's a useful exit route if you've got a number of shareholders and only one necessarily perhaps wants to leave. He can be bought out by the company. If the company has got surplus cash in it, or obviously it could borrow internally to do so, as long as it's got the reserves and it's got cash to pay out to the exiting shareholder, it allows an exit, and where certain conditions are met, you can have capital gains tax treatment on that exit. But it is important that those conditions are met, otherwise the cash coming out will be treated as a dividend. And it has to be for the company's benefit. To get that capital gains tax treatment, it has to be for the company's benefit, for Mr. Grumpy in this scenario, to leave the company. And that could be they're just not getting on. Different ideas, the direction of the company. And you can get a clearance prior to buying the shareholder out. You can get a clearance from HMRC that the trade benefit test and various individual and company tests are met. And when I mention a clearance, it's important that each time you potentially can get a clearance from HMRC prior to a transaction, whether that be a demerger, whether it be company purchase of shares, you do so, because ultimately on sale, the buyer under his due diligence will be saying, did you get a clearance for this? And if they didn't, there's tax risk and there'll be more issues down the line and more work and perhaps more cost. Another exit, akin to a management buyout, but this is a family management buyout, is where mum and dad can't necessarily, got a valuable business, they can't necessarily afford to gift it all to their children. They want some capital value from the business, but they want to pass it over to son and daughter. And this is typically achieved by son and daughter who are now managing the business, forming a new company, swapping their 10% shareholding for new shares in their company, but giving mum and dad an IOU, often in the form of redeemable preference shares. And as profits are generated in the trading, if there isn't a lot of cash in there now, as profits are generated in the trading company going forward, they can pay down the IOU, which could be loan notes or pref shares. Mum and dad can continue as directors. And if mum and dad continue in the business and retain a small shareholding of at least 5% each, you can continue to get 10% tax on the pay down of the redeemable preference shares. How does that work? Well, I've just put it in words here effectively. If they don't keep the 5% shareholding, they can get their business asset disposal relief up front. If they do keep their shareholding, if you think it's likely that tax rates go up, you can still be treated as paying, you can still be treated as receiving all the money up front, pay the tax. If you'd rather pay 10% now rather than risking paying a higher capital gains tax rate on future tranches of payout in future tax years. And in this scenario, as with the company purchase of own shares, there will be a little bit of 0.5% stamp duty by the company acquiring the shares. I don't know if Alison mentioned, I think she did, Employee Ownership Trust, which is a vehicle that started, it's been around since about 2014, and it's about sort of the John Lewis model. It allows a trust or an employee trust to acquire at least 50% shares. It creates a market to sell the shares. The employees effectively take over ownership of the business. And the nice tax advantage here is it's a capital gains tax-free sale, but it's an arm's length valuation, and there are lots of requirements there. Works in a similar way to the FAMBO. Future profits can be used to pay down the outstanding IOU. I won't go into detail, but it is something that is becoming more commonly used. And finally, it was mentioned closing down and extracting the proceeds. That's fine. If it's on a formal liquidation, it should be capital gains tax treatment in the shareholders' hands. And if they met the condition, the trade ceased within 3 years of extracting the funds for business asset disposal relief, they should get a 10% tax rate up to £1 million. The government did bring in some rules in recent years, though, about phoenixing of companies, closing it down, getting the 10%, starting up again and doing that. So you have to be a bit careful that you're not going to be starting a similar business or trade within 2 years of selling out. And if you are liquidating, because if you're caught by this rule, you can be taxed as a dividend and you won't get the capital gains tax treatment that you hope for. So that really is a very quick run through. There's a lot of detail, as always with tax, and the answer is always it depends. So with that, I will leave that with you and hopefully stop sharing.
Yes, thank you. Yeah, thanks, Ian. Yeah, never a truer phrase, is it? You know, it depends. So it just proves the, sort of getting the right advice at the right time. But just one question. A lot of the time, clients and what have you, if they've got like a limited company and they're selling, but sometimes the buyer wants to buy the shares and sometimes the buyer wants to buy the trade. Can you just explain the tax difference of those two?
Well, the sale of the shares, as I didn't have a slide for it, you're simply selling the shares, that's your asset, proceeds less cost, 20% CGT rate, unless you meet the business asset disposal relief requirements for a 10% tax rate. And by selling the trade from within the company will probably make a capital gain on sale of the goodwill. That will be taxed at 19% currently. The post-tax cash left in the company, well, either you start something up again in the company or you liquidate the company, at which point, as long as you're not caught by the anti-avoidance rule, restarting something, a similar business within 2 years, you then pay tax, bringing the funds out to shareholder level, and you would pay tax at hopefully 10% on the gain made on bringing the funds out. Obviously, you've got flexibility how you bring the funds out. Yeah. You could fund a pension contribution if you do it at the right timing, or you could just, but effectively there's double tax. But Alison would probably tell you that when the buyer is putting the price on the shares, they factor in the inherent tax liabilities in the company. So it's not necessarily like with like.
Okay, yeah, thanks then, Ian. I'm just conscious of time, so I think we'll move swiftly on to Giles. So Giles, over to you.
Thanks very much, Patrick. I'll just share my screen quickly. Okay, hopefully everybody can see that.
Yep, good.
Right. So I'm just going to spend the next 10 to 15 minutes running through the legal aspects of a sale of a company or a business as a going concern. So I'll just go on to the introduction slide. So, I mean, broadly, this is just going to cover what to expect in terms of the legal process and the most important areas to focus on. So I think kind of reflecting a lot of what Alison said in her first presentation about preparation, preparing early can enhance the value of your business and reduce the risks of delay and abortive transactions and increase professional costs in a number of ways. Firstly, you can secure terms with key customers and suppliers, which is always going to be important to a buyer. You can identify what consents are needed to transfer important contracts to a buyer. You can prove to a buyer that you own a key asset, for example, a registered trademark or other valuable IP. So a lot of businesses have very valuable trading names that they assume that they own the rights to. But for example, having a registered trademark will give you much more valuable rights than simply having a common law right to make a claim for passing off if you're just relying on the goodwill in your trading name. And there's other types of intangible assets that you can shore up in different ways as well with some IP advice. You could also look to give the company greater flexibility to reduce its costs, particularly if services provided to the company are likely to be duplicated by a buyer after a sale. So quite often it would be sensible for a would-be seller to look to negotiate, for example, break clauses with landlords and suppliers where appropriate, so that if a buyer comes along and says, well, I'll pay you X pounds for your business, but I want you to get rid of these suppliers and I don't want that lease, you've got a route out rather than having to pay expensive break fees, which really kind of, reduce your net proceeds of sale in the end. Again, just touching a little bit on what Alison said, you could look to reduce the reliance on yourself as the founder by having an incentivized management team signed up with robust service agreements. And one way that you might persuade them to do that would be, for example, to offer them an EMI option, which is a tax advantage way of allowing them to buy into the company. And then if you've got a really good, strong management team, and assuming you're going down a trade sale route, then you can still demonstrate to a buyer that the business can operate effectively without you. And that actually, I think, is shown to increase the value of a business, because if it can run without you, then it's valuable in its own right, rather than you being the asset. And another thing that you can do is just to identify regulatory issues that might be lurking in the background that nobody ever thinks about until a sale. A classic example would be failing to renew or even get a license in the first place. We do come across these things on due diligence exercises, and it's much better to get it sorted out ahead of a sale rather than it come to light during the course of a sale. So then, assuming that you've done all your good preparation work and you found a buyer and you're happy with the price that they've offered, you then kind of go into the initial stages of a corporate transaction or a business sale in normal language. So non-disclosure agreements, what are they? They're essentially confidentiality agreements, and it's really important that a seller ensures that a buyer signs a legally binding confidentiality agreement before you pass across information relating to the business, particularly if it relates to employees, customers or suppliers. It's not only important from a commercial perspective, but it's also important from a compliance perspective. So, for example, data protection laws require businesses to take steps to protect personal information. So as well as having a good NDA in place, it's always a good idea to take legal advice before disclosing any personal data to buyers. I think that's something that's really become much more prevalent in the last 5 to 6 years, really, particularly with the advent of GDPR 3 or 4 years ago. You then move on to heads of terms, and heads of terms set out the broad terms of a deal, typically really basic things like the purchase price, the assets to be acquired, and any bespoke terms agreed between the parties. They're normally non-legally binding, and it's generally much easier to negotiate terms with a buyer at this stage of the transaction. So normally what we see is a buyer's position will harden after heads of terms have been signed, and then sellers will usually find it difficult to move away from what's been agreed in the heads if they want to complete the deal. So even though they're not legally binding, you do find that actually you're stuck with them in many ways, because people put a lot of weight behind them until you have accusations of moving the goalposts and things like that if you try to move away from what's in the heads. And a buyer will also normally require an exclusivity period of around 3 to 6 months to complete a deal after heads of terms have been signed. So during the exclusivity period, a seller would be in breach of contract if they continue to market the business for sale or deal with other potential buyers. And in this case, a seller could face a claim for damages, particularly if you've got a buyer that's incurred substantial fees in dealing with the transaction. So you would normally expect to have to sign up to some form of exclusivity agreement if you've got a buyer that's really serious about acquiring your business and spending money on corporate finance advisors, solicitors, etc., to get the deal done. So then, once we've gone through the preliminary stage, we get into the real nitty-gritty of the legal process. So typically a business sale in general terms will either be structured as a share sale or an asset sale. And this was touched upon by Ian in his presentation on the tax treatment of the two. So just a broad legal explanation of a share sale is where the owner of a limited company sells the shares in the company to a buyer. And as the buyer acquires the company itself and not just its assets, it will inherit all of the company's liabilities. And as such, a transaction that's structured as a share sale will involve a lot more due diligence and professional fees when the transaction comes around. An asset sale is where a business owner, which could be a sole trader, a partnership, or a limited company, it's usually one of the three, sells its assets to a buyer, which usually comprises goodwill, real estate assets, plant and equipment, intellectual property assets, and stock. The seller will normally retain liabilities such as creditors, tax liabilities, and liabilities for past claims. As a matter of law, though, I think sellers need to be aware that all employee liabilities will automatically pass to the buyer under the TUPE regulations. So that's just one to look out for on a transaction. So then after signing the heads of terms, after signing heads of terms, a buyer will usually issue a legal and financial due diligence questionnaires, and answering these requests will entail collating a large volume of documentation and usually takes up a significant amount of management time. So electronic copies of documents are usually uploaded to a secure electronic data room, and that's normally hosted by the seller's solicitors, and that can be accessed online by the buyer and its advisors to do their due diligence review. Then following the early stages of due diligence, a buyer will then normally issue a draft sale and purchase agreement. So this will either be a share purchase agreement or an asset purchase agreement, depending on the structure. And the document itself will normally run to around 70 to 80 pages of quite detailed legal text, which normally comes as a bit of a shock to most sellers that I act for, but that's what we normally see. As the negotiation of the sale and purchase agreement progresses, the sellers will normally prepare a disclosure letter, and that sets out any imperfections in relation to the business, such as a regulatory issue or a potential claim by a customer or something like that. And then following a review of the disclosure letter, a buyer may want to negotiate better terms or even reduce the price if information's been disclosed that they weren't expecting. Once the the sale and purchase agreement, let's say SPA, and disclosure letter have been negotiated and agreed, the seller and the buyer will exchange contracts and often complete on the same day. And at this point, the money changes hands and the buyer will become the new owner of the business. Check if still okay for time. I'll just whiz through these last few slides quite quickly. So just touching on the key points of the sale and purchase agreement. The first one is quite obvious. It's the purchase price. On simpler transactions, the price is often fixed, but it's often the case that the SPA will contain detailed clauses which will adjust the price depending on certain factors. So a lot of the lawyer's time is spent negotiating those types of clauses because there's so much value riding on them. So there's often quite a bit of negotiation around those areas. Warranties and indemnity. So just a brief explanation. A warranty is a contractual statement made by the seller and a schedule to the SPA. So for example, a seller may warrant that the company has not provided defective goods or services prior to completion. And if that warranty turns out to be untrue, a buyer may have a claim for damages based on the reduction in value of the company or the business as a result of the warranty being untrue. However, if the seller has disclosed the relevant issue in the disclosure letter, then typically the buyer won't be able to make a warranty claim in relation to the matter that's been disclosed. An indemnity is a promise to pay the other party where a certain circumstance arises. So for example, if a buyer discovers during due diligence that a seller has failed to correctly calculate holiday pay, and we see that one very regularly, then a buyer may require an indemnity for any losses as a result of that error. Because an indemnity is effectively a covenant to pay, they're very strongly resisted by the sellers and their advisors normally. And restrictive covenants, they set out what a seller cannot do for a set period after completion. So they're invariably included in the SPA and are intended to prevent the seller from setting up in competition or from poaching customers, suppliers, or key employees. If a restrictive covenant is breached, the buyer may have a claim in damages against the seller and may even be able to apply for an injunction to stop the seller from actually doing something. I will just whiz through this last slide very quickly. So just to sum up in terms of conclusions and top tips, preparing in advance will almost certainly make the sale process much smoother and help you to achieve the best price for your business. Many sellers don't take advice on heads of terms and usually only instruct solicitors after they've been signed. Sometimes that can be a bit of a false economy because then you find you have to negotiate terms further into the transaction, which can actually be more costly and time consuming. We quite often see needless delays where third parties are brought in right at the last minute. So if you need a bank consent or a landlord's consent to assign a lease, or quite often you'll need a regulator to give consent for a change of control of a business, it's a really good idea to get that process underway at the start of the transaction so that you don't have a last minute delay. Deal with due diligence requests thoroughly and efficiently. I think quite often we see due diligence answers coming back from sellers that aren't particularly well populated, and unfortunately all that really does is hold up the transaction because the buyers will just keep asking until they get the information that they want. So everything's much smoother if you just get your head down, get the information together basically. And finally, it may seem counterintuitive, but disclose all the problems, get them into the disclosure letter, because as you can see from the previous point about warranties, if you disclose something, it's far less likely that a buyer will be able to make a warranty claim in relation to what's been disclosed. So I think any other questions are going to be picked up with Ian, sorry, not Ian, with Patrick at the end. So thanks for listening, and I'll hand back over to you, Patrick, now.
Yes, thanks, Giles. A couple of questions then. You mentioned sort of restrictive covenants. I mean, how long, I suppose how long is a piece of string, but, you know, is there any set length to them to sort of maximize their effectiveness? I'm guessing the longer they are, the less effective they're likely to be.
Yeah, so that's a really good question. I mean, restrictive covenants are notoriously difficult to enforce, particularly in different contexts. When you sell your business, that's probably one of the more likely contexts where a restrictive covenant will be enforceable, because quite often what you're selling is the enterprise value or the goodwill in the business. And so a buyer really does have a right to say, well, if I'm going to pay you £1 million for the business you've built up, it's really not fair if you then go and set up a competing business down the road. So generally, you can have a fairly long period for a restrictive covenant for non-competition and non-poaching of suppliers and customers where you sell your business, of normally anything up to 3 years. Whereas if you contrast that to a restrictive covenant in a contract of employment, anything more than 6 months is probably on shaky ground in terms of enforceability.
Yeah, okay, thank you. And we had a specific query sort of on the registration process relating to solicitors from Richard. How important is obtaining additional runoff cover given the demise of SIF, and who provides it? So just a quick response on that one. I know it's a bit specific, but
no, absolutely. I think that's a really good question. It's something that I did see come up in a Law Society Gazette article recently. So, as I understand it, the Solicitors Indemnity Fund is coming to an end. So, for solicitors who are bringing their business to an end, if they don't transfer it to a successor practice that would normally inherit the liabilities of the original practice, then you would need to obviously put in place a professional indemnity runoff cover. But that, as I understand it, normally only lasts for about 6 years. I think the issue at hand, and it's probably the point that's being got to in the question, is what happens after that 6-year period. And I would say, yes, I would certainly recommend looking into getting longer runoff cover if possible. From what I see, because I do a lot of sales in the financial services IFA sector, and I think the PI market's probably not quite as effective as it used to be in terms of offering, comprehensive runoff cover. I think insurers are less willing to insure for longer periods for runoff. So it's a good question and quite topical. And I don't think there's an answer in terms of how you insure beyond that 6-year period for any claims that might arise after then. So
okay.
I think that's watch this space, I think.
Watch this space, yeah, lovely. We had a great question earlier relating to, and this is for you, Alison, from Melinda, who's saying, hello, no one could have seen COVID coming. In your experience, when looking at multipliers, what effect would COVID have on that? Would they would a potential buyer take that into account, COVID, or would they just look at, or would you as the professional look at kind of the likely figures going forward? What do you think?
Well, that's it's obviously very specific to the particular business in terms of how it's been impacted by COVID. But generally, I mean, looking at sort of the multiples that are being paid and sort of stuff that's coming out from various deal databases, multiples on the whole have held up okay throughout COVID. Obviously, if you've got a business that's completely on its knees or whatever, that's a different scenario. But generally, they are holding up. I mean, they're not back at pre-COVID levels yet, but there hasn't been a significant drop in multiples being applied. As I say, it's very specific to each individual case. In terms of valuing a business, as I said before, it's all about looking at the maintainable earnings and what they're going to be like in the future.
Yeah.
Pay back to the buyer. So if the impacts of COVID on that business can be shown to be an exceptional item and a one-off, and actually they will return to their normal levels of earnings, then buyers will take that into account when they're looking at the value. But obviously there's a lot more to look at in terms of the impact, how will the business return to its historic levels of maintainable earnings. So, and I think that will lead to more due diligence being done, both legal and financial, by a buyer. So yeah, that's,
yeah.
So it's, yeah, that's, that is, I don't know if Giles is seeing that in terms of sort of multiples they're seeing on deals.
Giles, would you comment on that? You're on mute.
Yeah, I mean, I've not got the technical kind of insight of Alison, but I think from what I've seen, multiples have held up relatively well, in terms of deal values. And I think probably what we've noticed is there seems to be plenty of buyers out there with no shortage of funding, so they can come in and actually, pay the vast majority of the purchase price on completion rather than deferring everything and it all being contingent on a, post completion trading. So yeah, from what we've seen, things have held up pretty well, particularly considering where we were about 12 months ago when it looked like deals were going to be much thinner on the ground.
I think one other point actually worth mentioning, probably more about the structuring of a deal. I think we're going to see more sort of contingent maybe and deferred consideration coming into the structure to actually protect the buyer against, are those profits going to be there in the future? So we're seeing that more in terms of the structuring of deals.
Okay, thank you. Yeah, thanks, guys. Just a couple of final points then. I think, yeah, again, we've had another couple of queries just saying about provision of e-certificates. So sorry, we can't do that. But the better news is we've had a query asking for copies of the slide deck. So Alex will send copies to you in the sort of after the meeting. So, and I'm conscious of time. We are at 3 o'clock now, so I will sort of bring it to a close. Wrap things up. As I say, if you have any further questions not related to e-certificates, I would suggest just stick them, post them to us, on events@thomaswestcott.co.uk, and I promise we will attend to each and every question as to, I'll funnel them off to whomever is most appropriate. Please also look out for future webinars. We've got a webinar in a couple of weeks, I think, so details of that to be firmed up. And finally, I'd just like to thank our speakers today, sort of Alison, Ian and Giles, for coming on. Great presentations, all three. So yeah, have a great rest of the week. Don't worry about the rain because we can go in the pubs on Monday. So on that note, stay safe, Devon and Somerset, and see you next time. Cheers for now.